Hey, are you sitting on an old 401k, 403b, 457 plan from a previous job, or an IRA, or even a Roth IRA? You know, one of the best ways to make your asset protection plan much more effective from the devastation of one of the three big areas of asset protection planning that goes largely overlooked: market volatility and the annual destructive losses from fees. That is the fixed indexed annuity. My name is Kurt Jackson, asset protection planner with KJ Financial. So when we defined creditor as anyone or anything that could take away your wealth, money, or assets, the stock market was one we certainly wanted to include. Why would we include that? Well, great question. Since 1900, we've averaged about a 47% loss every 11 years. Since just World War II, we've averaged a bear market every 6.14 years with an average loss of 33%. Think about it, we've had three huge stock market crashes just since 2000, all of them which were very, very costly. While we're taught when you're young that you can afford to take risks in the stock market because if you lose money, you have time to get it back, is that really true? Let's say it takes you 20 years to build up a good nest egg while you're working, and then you lose 42% or more like we did in 2000 to 2002, or almost 59% in 2007 to 2009, or 33% in a month in 2020. So how long will it take for you to get back to even? What if it takes 3 years, 5 years, 10 years, right? Aren't we now 20, 23, 25, 30 years into your working investment life? It took almost 6 years to recover from 2002. Then 2007 to 2009 hit. Doesn't it kind of seem about the time we've gotten back to even another crash happens? Since World War II, those bear markets have taken on an average 1.33 years to hit the bottom, and then 1.87 years to get back to even. So about 50% of the time, you're earning a 0% average return. Does it make sense to keep doing that over and over? What if we could avoid losses and still grab gains when the market or the index was up? But more importantly, lock in those gains and all the contributions and all our previous gains each and every year. How powerful could that be? What if we were also doing that with no fees? How powerful would it be to remove the destructive forces of fees that you have to pay each and every year? As we get older, aren't we taught to have a diversified investment portfolio? Traditionally, a mix of 60% stocks and 40% bonds have largely been recommended. But what if instead of bonds, since look, they're not necessarily safe, especially bond funds that are traded on the market, we used a fixed indexed annuity with a 4.5% cap and a 0% floor, okay, linked to the S&P 500. So that means our gains are capped at 4.5%, but never lose money. How do you think that might look? Using our on-point risk analysis tool, here's what we found for the 10 years that ended in April 1st of 2020. In the past 10 years, the 60-40 stocks fixed index annuity mix outperformed the traditional 60-40 stock bonds mix 10.47 to 8.66% per year. And that's a compounded annual growth rate. Okay? That means it's an actual return. That's 21% more. What if we went back to September 1st, 2003? That's the furthest our data would take us back. Once again, it outperformed 8.62 to 7.18% compounded annual growth rate. It's about 20% higher. Did that shock you? So depending on your investing horizon, how long before you'll need your money to create that lifelong retirement income, fixed index annuities are a great way to help mitigate that stock market risk, especially for money that's in qualified retirement plans like a 401k, a 403b, 457 plan, IRAs, even Roth IRAs. If any of this money is from old employers, okay, or accounts that you've set up outside of work, you could make changes now. For money still with a current employer, we'd need to find out if they do in-service withdrawals. Most don't, but many will if you're older than 59 and a half. That on-point risk analysis tool we mentioned earlier, it also will do a personal risk score for you. When you're getting your personal risk score, one of the questions it asks is how much of your portfolio would you allocate to 3 different buckets. The first bucket would be the portion of your investments you'd want to safely earn 3 to 5% a year over time, and is something a fixed index annuity would fill perfectly for many, many folks. So we're going to go ahead and put the link to the OnPoint Personal Risk Score app up on the screen now, and we'll also put it in the information box below in the video. So if you want to continue going on through the video, you don't have to click on that link right now. But we really encourage you, please go get that personal risk score. And once you've completed that, we'll send you the link to see how much risks you have in your current investment portfolio. You're able to look at to be able to put those ticker symbols in there and figure that out yourself. You're likely going to be amazed at how much risk you're actually taking. So the bottom line today that we're talking about is fixed index annuities can be a great fit for the safe portion of your qualified retirement accounts. If you have money invested outside of qualified retirement accounts and you'd like to potentially get even more safe growth, the middle bucket that we were just talking about, the left bucket, this is the middle bucket. Make sure to check out our videos on Index Universal Life Insurance. You'll be happy you did. Yeah, even if you think you've never heard anything good about cash value life insurance or Index Universal Life Insurance, take our word for it. Check it out. Don't cost nothing, and we'd hate to see you miss out on all the opportunities and benefits that are involved in those. Check out our other videos on our YouTube channel, Asset Protection Nation, or you can. Hopefully something's popping up on the screen here that you can register for our more in-depth Asset Protection Nation Masterclass on-demand webinar. That's just a fancy way of saying you can watch a recorded version of our webinar anytime you like. We go into a lot more depth than that. We think it'll help explain things. Let's give you some more numbers to digest. So if you have questions that we didn't cover today, or maybe our information created some new ones, please enter them in the comment section below. We try to address them as quickly as we can. And when we get really great questions, we may even do a video about it. Also, if you found value in the video that we shared, please do share it on your social media, and make sure to subscribe to our YouTube channel. There should be a link coming up to do that by clicking the icon on there. That way you'll make sure that you get all our future content. Right? Hey, I want to thank you for stopping by. Certainly hope we get to meet some.